Bankruptcies climbing 15% year-to-date while the S&P 500 sits at all-time highs? That's a big disconnect between Main Street and Wall Street. When that happens, it's usually a sign the market's story and the economy's reality are pulling in opposite directions. Traders call that a divergence, when prices and fundamentals stop telling the same story. Now, I hate to be Mr. Doom and Gloom here, but honestly, this isn't something to ignore. Here is what this usually means. The rally's narrow. A handful of mega-cap tech names, Apple, Microsoft, Nvidia, Amazon, are carrying most of the index. Meanwhile, the average company is wrestling with higher costs, shrinking margins, and slower demand. Credit card balances are at record highs. Auto loan delinquencies are climbing. Layoffs are quietly spreading beyond tech. For everyday Americans and small businesses, it doesn't feel like a bull market at all. Liquidity masking weakness. AI hype, passive ETF inflows, and hopes for rate cuts are pumping liquidity into markets, propping up valuations. Traders are betting on what might happen instead of what is happening. That illusion can last months, but eventually fundamentals catch up. The lag effect. Monetary tightening takes time to bite. It begins with higher borrowing costs, turns into reduced spending, and ends in defaults. Wall Street is cheering for a soft landing, but many households are already living through a hard one. If bankruptcies rise while indexes hit records, it's not a healthy bull run. It's a divergence, and divergences always resolve, one way or another. How these divergences usually play out. 1. The cracks start with consumers. Rising consumer bankruptcies are often the first domino. Watch for credit card delinquencies edging higher. Auto loan defaults climbing. Buy now, pay later limits tightening. These are the early warning lights. Once households start missing payments, retailers, lenders, and small-cap banks take the first hit. Big brands may still post profits, but the middle class is quietly underwater. 2. The spread moves up the chain. After consumers, the pressure hits businesses. Signals to track. Small business bankruptcies in restaurants, retail, and construction. Falling freight volumes, less shipping means weaker demand. Softer earnings guidance from mid-cap firms. That's when headline data still looks good, but the underlying economy starts to wobble. 3. Market narrowness exposed. This is when the divergence becomes obvious in the charts. The S&P 500 might be setting records, but a handful of stocks are doing all the work. The equal weight S&P 500, RSP, shows how the average stock is performing. RSP gives each of the 500 stocks in the S&P 500 the same weighting, 0.2% each, instead of weighting them by market cap like the normal SPX or SPY does. Here's why it's so useful for spotting market divergence. When SPY, which is cap-weighted, is hitting new highs but RSP is flat or falling, it means a few mega-caps are carrying the market while the rest are lagging. Right now, the equal weight S&P is lagging the main index. That's an early warning sign. The advance and decline line hasn't rolled over yet, but if it does, while the S&P stays near highs, that's when divergence becomes undeniable. When fewer stocks drive gains, the market's foundation weakens. If those big names rotate lower, the whole structure caves fast. 4. Defensive rotation. Smart money doesn't panic. It rotates. You'll see funds quietly move into utilities, healthcare, consumer staples, out of cyclicals, small caps, speculative tech. Defensive sectors outperforming during a bull run usually means one thing. Investors are hedging while pretending everything's fine. That's a topping phase, not a healthy rally. 5. The snap moment. Eventually, something breaks. An earnings miss, a credit event, or a policy surprise. That's when the VIX spikes past 25. Retail sentiment flips from FOMO to fear. The everything rally deflates fast. Confidence evaporates. Liquidity dries up. Stocks that went straight up start falling twice as fast. And suddenly, the headlines shift from soft landing to economic slowdown. The numbers don't lie. Let's look at the actual data behind this divergence, because this isn't just theory. Bankruptcy filings are surging. Total bankruptcy filings jumped 13.1% year over year in 2025. That's 529,000 cases versus 467,000 the year before. Business bankruptcies? Up even more, 14.7%. And it's not just small businesses struggling. 63 large U.S. companies filed for bankruptcy by June 2025, the highest number since 2010. That's mid-cap and large-cap companies with real balance sheets, real employees, and real market presence. When companies of that size start folding, it's not a blip, it's a trend. Consumers are drowning in debt. Credit card delinquencies hit 3.05% in Q1 2025, nearly double the 1.6% we saw back in 2021. Now, banks are charging off 4.31% of credit card debt as uncollectible. That means lenders have given up trying to get the money back. Student loan delinquencies spiked to 7.74% in Q1 2025, up from under 1% just a quarter earlier. That's the repayment shock hitting hard. People who paused payments during COVID are now buried. Overall, 4.3% of total household debt is currently delinquent. That's millions of families falling behind on mortgages, car loans, and credit cards all at once. The market rally is fake breadth. Here's the kicker. About 59% of stocks are down 10% or more year to date. Let that sink in. The S&P 500 is at all-time highs, but most stocks are losing money. The equal weight S&P is lagging the cap-weighted index by 13.4%. 9 out of 11 sectors are underperforming. Translation? A tiny handful of mega-cap names are holding up the entire market. The VIX is currently sitting at 24, right at the threshold. That's not complacency anymore. That's the market starting to smell smoke. Historically, when the VIX pushes past 25, that's when the snap moment arrives, when fear goes from background noise to front-page panic. We're not there yet, but we're close. And here's the thing, the VIX doesn't spike because everything's fine. It spikes because the divergence between price and reality is about to resolve. Right now, Wall Street is getting nervous. Main Street has been nervous for months. And that gap, it's about to close, one way or another. Look, I'm not saying the market crashes tomorrow, but I am saying the warning signs are flashing red. When bankruptcies surge while stocks hit all-time highs, that's not strength, that's illusion. When a handful of megacaps carry the entire index while 59% of stocks are down double digits, that's not a bull market, it's a house of cards. And when the VIX sits at 24, knocking on the door of panic territory while Main Street is already underwater, that's not a soft landing, that's a delayed reckoning. Either the economy catches up to the market or the market crashes down to meet the economy. Right now, all the data points to the second outcome. So pay attention. Watch the credit markets. Watch the equal weight S&P. Watch consumer spending. Because when this snaps, it won't be slow, it'll be fast, brutal, and merciless. The smart money is already rotating. The question is, are you ready? And hey, I hope this video helps you on your quest for profits. Catch you on the next one.